147 points higher for the Nifty futures. It's a solid 1% start. You've got a good market breadth. ICICI Bank, your top winner, almost nudging that 600 rupee per share mark. 595 in the futures is where ICICI Bank currently is. PVR after that dip below 1,000, it immediately saw some buying coming in. Now it's scaling up. 1161 is where the stock is. SAIL, Infosys as well as Axis Bank are your other winners in trade. Britannia reports its numbers tomorrow, going weak into its numbers. It's down about 2% as we speak, as is the case with HCL Technologies after its earnings. Lupin, Shriram Transport, M&M Finance and Dabur along with Marico are some of your other laggards as we speak right now. But let's talk about where the markets are headed, what is happening with the COVID crisis, and where is it that the two are going to meet, the economy and of course the medical news as well. We have with us Amish Shah from Bank of America Securities joining in the show right now. He's written a very interesting note on how the second wave is going to impact markets. Let's chat with him exactly about the same. Amish, hi, good to have you on the show. Morning, firstly. Just wanted to understand, how is it that you're reading all the news around you, given that we are in the midst of a healthcare crisis with regards to the second wave? How does that tie in with the market mood?
Well, good morning, and thanks for having me on the show today. So in the near term, clearly this is a pretty big crisis. Numbers, COVID cases seems to be accelerating quite fast. And in the very near term, if I were to take like a 1 month view, I think markets may be headed for a little correction because this is going to be driven by earnings cuts. I think both the commodity price risk as well as the risk of COVID surge is not completely priced in the consensus earnings. So as the results keep coming, I think earnings will keep getting downgraded. But I don't expect the market fall to be any significant. Because incrementally, if you look at it, the visibility of vaccines accelerating is improving. We've done another report where we highlight that in the most bearish case, about 34% of Indians will be vaccinated by the end of this calendar, and in the bullish case, that number could be about 48% of the population. So that's a pretty wide spread, and I'm sure that we will settle down somewhere in between, which is encouraging. And as more and more vaccines keep getting approved and the news flow of that keeps accelerating, I think that the markets will look forward and not worry so much about the surge that we are seeing in COVID cases right now. So slight correction from where we are on the back of earnings corrections, but then we continue to be constructive on the markets long term.
Okay. With that view in mind, that short term perhaps the markets could correct a little bit, but long term the bull run remains intact. Where are the sectors in the near term where you see an earnings surprise, and where do you think there's going to be a disappointment on account of the statewide lockdowns in the second wave?
So in the near term, I think the defensive sectors, predominantly healthcare, staples, your IT. These are going to be relatively giving surprise beats, because they have relatively nothing to do with the lockdown. As a matter of fact, the lockdown helps them. Healthcare companies, it helps them. Staple companies, people stock up at their homes. So it helps them. So in the near term, I think the defensive sectors will do well from an earnings perspective as well as relatively. But that's a short-term trade. Otherwise, if you look ahead, we are bullish on the cyclical sectors, which is the financials, industrials, materials. They will do well, and the common binding theme across all of these cyclical sectors is going to be the Capex theme, which we think we are just at the start of a multi-year Capex cycle in India. So as the cycle keeps accelerating, all these cyclical sectors do well as well.
Okay, interestingly, and from that bunch, I noticed NTPC, power grid. So clearly, bullish thematically also on utilities there. Talk to us a little bit about the rationale behind that. Is anything particular that you're tracking in terms of factors that you feel might lead to a resurgence on some of these names?
Sure. So for utilities, they had become ex-growth. predominantly, because large part of the transmission capacity or the coal-based power generation capacities have already been set up. So these companies need to reorient themselves. They need to find avenues for growth from the newer areas in comparison to where they are. Let's say, as an example, instead of coal power, can they accelerate on the renewable power? Can they get into the hydrogen theme, which is too early in India, but hydrogen over time will become a very big theme? Can they diversify into power distribution business, which is likely to open up pretty soon on the back of the new law that is in the works? So the point being that one factor of growth for these companies will be on the back of how they diversify into newer businesses. And I think, we are about a couple of years away when that curve accelerates. But in the meantime, if you're a patient investors, some of these stocks are very, very cheap. So if you don't mind waiting, then this is a very good price to get in. If you really want to time the inflection point of earnings, I think it's going to be a couple of years away, but it's surely going to come for these companies. And the second factor that will drive the valuation multiple for these companies is the interest rate. Because the interest expense for these companies is a pass-through, but the discounting rate that we use in our DCF model is dependent on where the 10-year GSEC bond yields are. So that the time when the GSEC bond yield starts coming off or correcting, that is a time to get bullish on these companies.
Okay. On discretionary, sounding a little muted there, but give me a sense of why that is. Do you think the argument is different this time in terms of how demand is seen to come back later in the year? Or is it just that there are better options available as in the cyclicals as you just described?
I think it's the latter. So if you look at the pack of financials, industrials, materials that we spoke about, they are first of all not super expensive. In this market, nothing is very cheap, but clearly financials, industrials, materials is in a comfortable valuation zone. Discretionary stocks are not. So discretionary stocks are trading at lifetime high valuations. The earnings growth that is built in these stocks is very, very high. There is a chance of disappointment from there rather than positive surprises. Plus, as I was saying earlier about the commodity risk, so about 47% of the sales of a typical discretionary stock is commodity prices, is commodity cost. And large part of this commodity is things like steel. Steel, as we know, has already gone up by 75% up from June last year. But if you look at the earnings of these discretionary companies, they've just one way kept on getting upgraded. So I don't really think that the earnings are actually going to get met. In fact, I think that the earnings are likely to get cut. And in the context of that, valuations for those stocks look very expensive. And that's why we are underweight on that sector at this point in time. We would like to play the recovery story more through the financials, industrials, materials pack, as I spoke about earlier.
Okay, great. In terms of the kind of time frame that you're looking at as well, I know it's difficult to predict, but what's the kind of, even if we take a look at the cyclicals and the kind of return scenario you're anticipating, would you be taking a look at a 1-year view, 3-year view? What are you factoring in?
So I would argue that from both the time perspectives that you mentioned, the cyclical stocks should do very well. Because the moment we are saying cyclicals, the cycles typically last for 3 to 5 years, right? So like let's say a typical Capex cycle is 5 to 6 years, and we are just at the bottom of the Capex cycle right now, and therefore on the back of that, we think that the start of the Capex cycle will also be gradual. So it's not as if you're going to see a hockey stick curve growth up. If I put some numbers, we are expecting about high single digits, early double digits kind of growth for the Capex cycle over the next couple of years. And then from FY24 onwards, we think that it will accelerate meaningfully on the back of private sector Capex coming back. And this time around, private Capex visibility of coming back in F24 is very high. on the back of government opening up a lot of monopolies to attract private and foreign capital. So the point is that the cycle itself will slowly, gradually keep picking up. And if that happens, all of these stocks will see their earnings getting upgraded over time or over the years, as well as their valuation multiples expand on the back of earnings catch up. So, so both from 1 year, 3 year perspective, I think these stocks are reasonably well priced, and one can ride the whole cycle from a multi-year perspective too.
One space that I see in your top bets continues to be the staples. Is there not a worry when it comes to staples purely because of the RMC costs getting higher? I mean, input costs we all know have been inching up. I mean, it's not just pure play base metals which are holding up, but across categories, across commodity space, you are seeing raw material costs escalate, and that's weighing heavy even on some of these staples.
No, you're very right. But two things I would say there. First of all, up until the COVID surge started or the second wave started, we were actually neutral weight on staples because we thought that the markets may be headed for a little bit of a correction. We increased our weights in favor of the defensive sectors from a short-term perspective, and staples is clearly one of those. So it's a near-term or a tactical call on being overweight staples. Not our long-term thesis, number one. Number two, specifically on the raw material cost, within the discretionary space, the ability to pass on the entire raw material cost, I think, is relatively low. And that's why we are underweight on discretionary consumption. But within the staples, the ability to pass on the raw material price hikes is actually very high. So I don't particularly worry about commodities or raw materials hurting the staple companies. But by and large, the 15 to 20% earnings growth that the sector is likely to deliver, I think is adequately priced into these stocks at this point in time. And that's why our neutral weight from a long-term perspective.
Okay, Amish, great to have you on the show. Thanks for taking the time out and joining in, and stay safe.